Well, good afternoon, everybody. Welcome to our September 19th edition of Bull Sessions. That electric grid graphic in the middle of the page is kind of reflective of the weather we've had around here. Nice golden sunsets and some pretty nice days. My name is Mark Robertson. I'm joined here by Ken Kavula, and we just have a few things we want to kick around. There's no special significance of the Bulls being on the page, other than maybe just a tangential comment that when Dennis Rodman left Detroit to go to Chicago back in 1995, the instant I heard that actually had happened, I felt like they were going to win the championship, because everybody on that team, and even beyond those three guys, so deeply understood their role on the team. It was just a magical thing to watch, and we had courtside tickets at Chicago Stadium to see it, and it was just a great thing. The tangential comment to investing is, with any portfolio, just be aware that your positions, your holdings have roles in achieving success, and try to keep things balanced and prudent. So how's that for a little segue, Ken?
It's a reach.
Okay. Does it seem like I was sniffing hydrogen or anything unusual?
I don't know. You can't smell hydrogen, so
I'd check to see where the Elmer's glue is in your house.
All right. And well, Kevin, Wainwright actually got his 200th career victory last night, so I'm just going to toss some good wishes in the direction of the Baltimore Orioles.
It's easy to cheer for the O's and not cheer for my hometown team, the White Sox, because they make things extremely difficult to cheer for them.
Oh, the White Sox have had a terrible year. They're much higher expectations.
I'd say like a terrible decade.
Well, that too, but I thought they were going to do better this year. Anyhow, we're going to talk about some hydrogen stuff. We want to check in on the electrifying portfolio, and let's just take it from there. Here's our weekly reminder that Portillo's is not a sponsor of this show, but they should be. And I thought the ribs was a nice touch, especially this time of year. Yes, Portillo's has more than hot dogs, Ken. Okay, here's our boilerplate reminder that no investment recommendation is intended. Everything we do here is about education, specifically the demonstration and illustration of some principles, philosophies, techniques, methods, belief systems, communities, etc. at the Modern Investment Club movement. So you're going to hear opinions from us. Please do your own homework before making a decision. If we hold something that we're talking about, we'd like to let you know that. We'll try to remember to do that. Please form your own opinions, make your own decisions. We're a week out from the roundtable this month. Should be a blast. Ann Manning of Houston will be joining us, and we'll have some fun with that roundtable. That's been running since 2010. The rate of return on the tracking portfolio is now pushing back towards 16%, although our ducks probably didn't do it any favors here in the last day or so. But we will be convening that a week from today. Next Tuesday's roundtable or bull session will basically be some prep work for that. And if you'd like a reminder about those monthly webcasts, again, we've been doing them since July 2010, having some good, clean fun. Please send an email to nkavula1@comcast.net. Then if you have any suggestions or requests for this session, our two email addresses are there at the bottom of the page. Anything else, sir?
No, I think you've covered it quite sufficiently, Mark.
All right, here's our weekly check-in on the stock market as measured by the value line arithmetic average. Those are the green bars. Those are quarterly bars going back over 20 years. And the one on the farthest to the right actually locks in on September 30th. So it's shown in light green. It's still moving around right now. At the end of August, it was actually slightly above the blue trend line, so you can see what September has done to it so far halfway through September. So it's come back down a little bit, which means that the average return forecast on a stock in in our universe has actually ticked up a slight bit with that drop in stock price. So just a quick check in on that. At a future session, we'll take a look at multiple versions of this. Anything else, Ken?
Nope. Let's continue the slideshow.
All
This
right.
one is this one's just a great slide, Mark. It's one of your classics. Put that in a small folder of 5 or 6 other ones.
Yeah, this one's cool. I'm not sure exactly where I got it, other than it originally comes from BMO Capital Markets by virtue of FactSet and whatever. But what you're looking at here on the left is the S&P 500. It's a time series graphic going back 20 years, which basically displays EBIT would be a flavor of operating earnings or operating margin, and that would be more closely associated with our projected return on value calculation. The net margin, again, is earnings per share over sales, and that's basically the bottom line, and that's that light blue line across the center there. Now that's the S&P 500. So it's just showing us, and it's a reminder of where those have been typically over the last 20 years or so. I will argue that it's really not, I don't know, functionally correct to try to slap an average on those. Now, maybe you can slap an average on anything, but I really think that the trend line is probably more informative, more representative of the world. And we've been doing that for some time. The graph on the right is that same characteristic, in this case, percent net margin, with that mathematical trend line slapped on top of it. And you can see that the shapes are basically the same. We're looking at the same type of information. The only thing that's different is one is the S&P 500. The other is the value line industrials, which is basically about 1,400 companies from the Value Line Investment Survey. So what I find kind of interesting here, Ken, is that if you look back at our work over the years, a lot of times that 3 to 5 year forecast from Value Line out on the far right is much more ambitious. A lot of times it would be basically up here somewhere. And it's kind of interesting that it is kind of tamed down a bit. It is basically calling for an all-time record medium profitability in the long-term forecast, according to Value Line. But pretty fascinating. You can see the impact of COVID on 2020. And it just says a whole lot about, what goes on in the economy. What are your thoughts, sir?
I've been looking at these graphs on the left-hand side here, Mark, and I've been trying to square what I see with what I've heard on the news channels, and that's a lamentation of shrinking margins and a wailing almost of the fact that going into 23, margins were going to shrink, and this shows that they have, in fact. But if you state the fact in a slightly different way, I think it sounds a little bit different. Margins would be, if they only had gotten to where they are today in 2021, they still would be at a 20-year high.
Yes.
And that decline from what was a 20-year high, and looks like 2021 maybe, to where it is now, is nothing that I would wail about to any great degree, when I tell myself that that's still one of the highest numbers in the last 20 years, and by quite a bit. It appears that it's higher than what's been going on in the last 20 years. We don't see these negative margins as were quite common during that. There, I mentioned the lost decade again.
Yeah, well, back here,
Yeah,
that's not shown on the graph on the right, but back during whatever we're calling it,
the financial crisis.
the
But that
financial
whole
crisis. Yeah,
that whole lost decade, when margins appeared to be underneath the quote average, whatever that happened to be.
mm-hmm.
We it I think sometimes we just have to I'd like somebody to grab some of our commentators by the ear and just drag them into
Well,
a seat in a classroom and say, sit down and do some thinking about these graphs before you wail about them, or show us long-term graphs rather than 3-month graphs, that kind of thing.
well, there you've really hit on something huge. I mean, a lot of times they're looking at quarter over quarter or comparing last year's quarter to this year's quarter. And when that quarter a year ago was weird and you're comparing to it, guess what? You get a weird comparison. And so, I mean, what you're looking at here, first of all, you do see that surge in 2021 of when we opened up our wallets and returned to the malls and all the spending type stuff that is pretty obvious now. But even if that slacks off and tapers back to that 9% range, as is suggested there, under 10%, still not exactly the end of the world when you think with a long-term perspective. It's that simple. Long-term perspective.
And to sort of jump in on this one, the other thing is that we see a lot of people doing their SSGs, and they had this big run up after the pandemic, and now all of a sudden those margins that we look at, those quarterly numbers, are down because they're doing the quarter over quarter,
Right.
and they just sort of immediately sit there and take what would normally be, say, like a 10, 11% projection, and they now are projecting out 5 years at maybe a half or a third of that number. And it's just like you're missing what's going on here.
Yeah, and I think, as you do your studies, and if you're trying to project a trend from this point to this point, and you're looking at this as being the trend, that's going to cause a problem. So, yeah. Here's another interesting look, and it just kind of makes the point. This is taking the value line industrials, and it's the same graph, only the net margin is displayed at the bottom. The operating margin is displayed at the top there. And it just simply illustrates the food chain. The operating margin is the one associated with the projected return on value calculation. The net margin is basically the EPS driven variety. And again, we like to lean on both of those and counterbalance them against each other as we do our studies. And I think you can see why. And a lot of times that top one is much more consistent over the long term. You definitely see the disruption of COVID here, basically coming in and putting in quite a dink in both of those. So I thought that's kind of a cool chart. Am I the only one that thinks that?
I told you, I think that these types of graphs, especially when they're long-term graphs like this, are very useful for teaching purposes and for understanding where stocks, what they're really doing on a month-to-month or year-to-year basis. I just 5-year horizon, 5-year horizon, 5-year horizon. And I just find it so frustrating sometimes that you have to repeat that 1,000 times, even at a investment club meeting where the people are relatively sophisticated sometimes.
Absolutely. All right, moving on. I can summarize this slide in just a few notes. This is just a simple reminder to be careful out there, especially if you're relatively new to this investing thing. The IPOs get an awful lot of attention. Again, an IPO is an initial public offering of a stock. One of the biggest IPOs in recent years came out, I believe, Monday or within the last few days. ARM Holdings, ARM, it's a semiconductor company. And there's actually another one. I don't know if it came out yet or not, but it was scheduled to come out today, Instacart. And both companies have some fairly decent, not spectacular operating results. I don't know. I just got this instinct that they may have been priced a little high on day one. And this is just a reminder of what can happen after that first day. So, Ken, did you think that they were appropriately priced?
I think I've always thought, Mark, that an IPO was a bad idea as an investor. I've always wanted to wait until the IPO, the company had time to settle in as a public company. I've never looked at stocks that have been on the market for only 1 or 2 years, and I don't think it's a time in my life when I'm going to start looking at stocks like that. The track record is dismal for IPOs. That doesn't mean that 3 or 4 years into their history, you might not find a lot of gems. You might find a lot of great companies, but in the beginning of their holdings, folks that can say they held some of these stocks are neglecting to tell you the pain and suffering they went through during the first 3 or 4 months of owning that stock if they bought it on the first day of issuance.
Yeah, and in fact, just to make the point, I will retell the Facebook story. My wife wanted to own shares of Facebook from day one. I strongly advised her not to, but she didn't listen. She's usually right about this stuff, and she ultimately was. The stock price went from $40 on the offering day down to $20 within a few weeks. I had a few days to say, "I told you so, honey." And she said, "Hey, I'm in this for the long haul. Just go back to your cubbyhole." And approximately 4, maybe 5 years later, she sold those $40 shares for $340 a share. So it makes Ken's point pretty strongly. I mean, down 50% in the first few days of trading, but again, over the long term, especially after getting through the restricted period and everything else. In fact, she probably sold right after our Life After Google presentations here a couple years ago. And it's just a reminder of the powerful dynamics that are at work there. So on the right-hand side, you see just some words of clarification and opinion from Brad Perry, one of the friends of the Modern Investment Club movement. It's an excellent book covering a number of subjects, including IPOs. Now, he did make an exception for United Parcel Service, UPS, back pretty close to the time of that book. That was an example of one exception, but that was a very established company, fairly reasonably priced at the time. And Kevin, you were mentioning something from The Intelligent Investor. Did you find the reference?
I did, yeah. So this is from The Intelligent Investor. I'm on page 68 of my edition. This is the chapter on portfolio policy, negative approach, new issues generally. Our recommendation is that all investors should be wary of new issues, which means simply that these should be subjected to careful examination and unusually severe test before they are purchased. There are 2 reasons for this double caveat. The first is the new issues have special salesmanship behind them, which calls, therefore, for a special degree of sales resistance. The second is that most of these new issues are sold under favorable market conditions, which means favorable for the seller and consequently less favorable for the buyer, which is us.
Yeah, I think that pretty much says it. It rhymes with what Brad Perry had to say. It certainly rhymes with my personal experience. And full disclosure, I do own a couple shares of Rivian down at the bottom there. You'll see why here in a second, at least one of them.
I think, Mark, also we've been given a lot of IPOs in the last 3 or 4 years that were exceptionally, I don't want to say bad, but I'll say exceptionally unique in the fact that they had absolutely, well, they had absolutely no earnings and no prospects of earnings in the next 3 or 4 years. They were brought to the market because they had good, consistent sales growth, but they were completely supported by whoever was bankrolling them. They certainly weren't making any profit from what they were manufacturing or whatever service it was they were providing. And a lot of them have proved to be worth exactly what we thought they were worth, which was something close to nothing.
Mm-hmm.
Beyond meat.
Good stuff. All right. Here's just a quick reminder. I had proposed getting together in Punxsutawney to see the movie Dumb Money. Unfortunately, I have a schedule conflict that won't allow me to do that, but who knows? We might still build something along those lines, but just thought that could be some good fun. And it's only about 30 miles from Pittsburgh, Ken. We could probably find our way, somewhere
Oh,
near there.
I might find that bar and meet Mr. Donnelly in Pittsburgh and let you go to see Dumb Money in Puxatawny. You know, and
There you go.
get a review. I get a review. So.
Alternatives. All right. Just so you guys know that's out there. All right, here is our groundhog update. Ann Renly is in the audience with us. Congratulations, Ann. Continuing to hold up the lead for a few weeks in a row now. We do have quite a ways to go until February 2nd, 2024, but I've had a rough week, dropping down 9 places, thanks predominantly to Ardelyx, and they've decided to take some time off here in September. Very painful time off with respect to stock price, but pretty consistent group of leaders up at the top, and a pretty powerful group of investment clubs also hovering near the top. And Ken, you're still doing okay. You're still.
I'm still doing okay. I'm gonna push for the top 20 here. I'd love to be top 10, but I'll push for the top 20. Okay.
Well, Kim must have something in her portfolio that offsets Ardelyx, so that's working out okay. Good stuff. It is still continues to be a frustrating year for the second year in a row for our groundhogs, though. Only 1 out of 5 are beating the Wilshire 5000, and that's not normal. And checking it at a negative 2.6, again, that's because of our general broad interest in all of the above investing for the most part. The only way to approach that number is to be heavily invested in those stocks we talked about last week at the top of the market cap weighted funds. The household names of Google, etc., Microsoft, all of those companies that are in that magic group of companies. And still, to make the point that all of the above companies are kind of staggering a bit. We're down -5 for the value line arithmetic average. That usually beats or leads the Wilshire 5000. So that tells you what type of unique situation we're in. And yes, the monkey is still near the bottom of the list. All right, pressing on. I'm calling out. This is now a 6 rabbit alarm fire. We're coming down to our final 5 weeks, Ken, and we need to find some carrots. So, and of course,
Drop the 5th one from the bottom.
so all we can do is cheerlead. Now, buy the products of these companies, buy their stocks, do whatever you can to push us over the finish line. But we continue to be hopeful. These continue to be fairly well positioned, as evidenced by their return forecast. Now, they are running into a little bit of an issue there, probably, that explains some of the sluggishness. The market just doesn't forgive weaker expectations these days, especially for the smaller companies. But I don't know. Any magic elixirs you can see, Ken? Or
I don't have any magic fairy dust of any kind, Mark. All right.
so
My granddaughter came back from the Renaissance Festival covered in fairy dust, and she offered to lend me some, but I don't think it would work here.
Well, maybe sprinkle some on Semler Scientific and see if we can. We'll try that. We'll pretend that Aaron's magical dust ended up there, and hopefully we'll get a windfall here pretty soon. Okay, it's going to be painful going down to a second consecutive loss here, but hey, the White Sox don't have a monopoly on this sort of thing.
Or the Bears.
And how long have we been showing this every week, Mark? I think this is going on the end of the second year also, right?
Ye who believe in the jinx. All right. One last topic before we kick into the hydrogen stuff. I just thought this was kind of interesting. Again, in the Detroit area, please send your thoughts and prayers. The strike is going to impact our economy if it persists. It sounds like, I don't know, Ken, you're an expert on this type of negotiation. It doesn't sound like they're talking to each other. They're kind of talking past each other.
I don't think, Mark, that if the negotiations are serious, and I do think they're serious, that either side is going to tell you what's really happening at the table. So I kind of just put down anything I hear about what's going on at the bargaining table. I just put that down to somebody trying to fill time on TV or the radio or whatever. If you're really going to make progress out of negotiations like this, you need some security that some of the ideas that you're trying to pitch aren't going to be used against you a day or two later.
Yeah.
So you need the trust between the two bargaining teams, and that means you don't involve the press.
Yeah, and it's awfully hard to escape the media, but anyhow, it'll be interesting to see how it all progresses. For those of you not familiar, they are striking against all of the major automobile manufacturers here in the Detroit area, and selectively shutting down certain factories. So, for instance, the Jeep factory in Toledo is one of them that is shut down, and it makes life interesting for those of us that live and breathe this stuff all the time. All right, so one of the things that I put together is this. I actually did not read the complete article. I scanned it. There's a bunch of articles out there suggesting that the American companies are in a tough position when it comes to the EV stuff, with the exception of Tesla. Time will tell. I have found them to be better positioned than anybody would have believed. If you go back and listen to some of the conversations from a few years ago. But what I wanted to do is take this opportunity to show just one slice. What I've listed here is the automobile manufacturing companies ranked by their financial strength index at Manifest from top to bottom. And you can see some of those blue chip names up at the top that you hear about so much, down to some of the more challenged companies towards the bottom. And what I wanted to do is take this opportunity to just kind of show you some, not all, but some of the components of the financial strength index as we put it together. It obviously does include just a straight up reference to the value line financial strength, and then a few other different ratings. But we also take a look at two debt components, basically straight off the balance sheet. The one that you guys know about that we've talked about forever is this one here, this first component of what's the effective interest rate. In other words, what is the bank charging them, much like you would think about in terms of a mortgage or a car loan. How much are they charging? The stronger the company in general, with some exceptions, the lower the interest rate. So you can see those from top to bottom, and we basically use that as part of a ranking type system in coming up with the financial strength index. The other one that we haven't talked about so much, and I basically ratcheted up the influence, made it a more powerful influence here for lately, just this reality of the amount of debt that you have does matter. And what we do is we basically compare the long-term debt versus the enterprise value and then rank that. So the enterprise value, the long-term debt versus the enterprise value, and we correct it for the cash equivalents, just like we do in the enterprise value calculation. So then when you rank them, you get another input, which suggests potentially, and again, this is a small piece, but it is one piece of the puzzle, this second element, how much debt do they have compared to other companies? And another interesting tidbit, these companies highlighted out here on the end actually have more cash than long-term debt. And I was really stunned to see this one, Ken.
Stellantis, yeah, I think you missed BYD also has more cash
Yeah, it does.
than Jet 2,
I just
Mark.
grabbed
Yeah.
a few of them. Yeah, so when you have that type of a situation, and when you have billions of dollars in your checkbook, look at this situation at Tesla. Tesla can write a check and completely pay off their long-term debt anytime they feel like it. So it really doesn't even matter what the interest rate is on it. But I just found it kind of interesting that some of those companies have that much. And part of the argument in the article was Stellantis, or at least in other articles I've looked at in a similar vein, is that Stellantis is fairly well positioned in a number of areas. And this one does show a little bit better posturing than the other two majors in the Detroit area with respect to this one limited parameter. So I just found it kind of interesting. But it does show some of the elements that go into the financial strength index as we calculate it. And of course, Ferrari is a very interesting study. Any other thoughts, Ken?
No, lots of numbers, lots of numbers.
Yep. But again, the importance of the balance sheet just reigns through. All right.
I'm getting that same question we get quite frequently, Mark. If you can go back to that slide, I think the stars are just indicative of the fact that they're not included in the main value line. Am I right, Mark?
That's correct. Yeah, they're outside the standard edition,
Yeah.
and some of them come and go, but that's the reason for the asterisk.
Okay.
All right. Quick look at the utility portfolio. We're about 3 months into it. What I find kind of interesting here, Ken, is some of the more mundane, the connectors and the fobs and all that kind of stuff kind of have floated to the top so far. It's very early. These are the 20 companies that we picked out for this electrifying future portfolio. And the only one that's really performing badly is Enphase, and we'll take a look at that one specifically. And those three down at the bottom are just kind of holding, being held off to the side. So I don't know if there's any major surprises here. The one major disappointment so far, Enphase Energy, we'll take a look at. Here's a look at the portfolio by dashboard. Again, just seconding the motion that the companies like AZZ and Amphenol, Cabot's just a placeholder. They are up towards the top of this in terms of how well they've performed over the last 3 months. Okay, and here's Enphase. And we did look at this one fairly carefully. I mean, it's a company that makes a whole bunch of the connectors and plugs and stuff that go into a number of systems, including the solar panel hardware that goes along with connecting up to a residential electrical system, all that kind of stuff. And what I basically find as I read between the lines is just what I said there in that final sentence. They apparently are under some of the same pressures that Generac is, would be one way to think of it. And you can see that the analysts are still fairly optimistic here for the future outlook. Kind of fascinating that Value Line is a little bit more pessimistic, so we'll see how that works out. A lot of times that Value Line one will just kind of trickle up as the days go by. But any thoughts on this one, Ken? Any cause for concern or?
I'm not really familiar with this company, Mark, so I'm going to refrain from saying very much, except for the fact that it does make sense that if it's something that you have to borrow a lot of money to put into your home, people might be looking for different things than energy efficiency at the moment.
Yeah, so I think they're under some of the same pressures that have been kind of torturing us with Generac a little bit too. And that was one of the reasons we kept Generac out of the top 20, was just the way it had behaved and what seemed to be some fairly robust profit taking after that surge. This one also had a pretty good surge here in stock price. So you see a similar pattern to what we saw with Generac. All right.
This one showed up This one showed up on the top 200 in BI in April. I hadn't heard of it. And actually, one of the people in our webinar that we do here with the Maryland and DC chapters, they presented it at April. So shameless plug, go to YouTube, look for Digging into the BI and look for the April one. And we have someone did a really nice presentation, not me, on Enphase. But yeah, solar energy manufacturer.
Yeah, and this is perhaps an opportunity for one of those. If we liked it 300, we really got to like it at 120. So, just kidding, just kidding. I'll duck a little bit and just move along. All right, Ken, you would like to talk a little bit about the hydrogen economy? I got a kick out of going through some of this stuff. I think I've told you before that part of my college senior thesis was on the hydrogen economy. But that was a few decades ago. I'm not going to get specific. But what I'm finding is some of the stuff that we talked about several decades ago is starting to materialize. So I'll let you expand on that.
Well, I want to give credit to where these slides, some of them came from. They come from a company's website called Plug Power, and they have a pretty interesting investor relations section in Plug Power. Not only does it have some pretty interesting presentations, but it also has a lot of references on where you can go for more information and a wealth of articles, both pro and con, about what's happening with energy and what's happening specifically with transportation. I want people to keep an open mind when it comes to the next vehicle that is going to reduce emissions into the atmosphere. And I don't want anybody, after doing quite a bit of digging, I don't want anybody to automatically assume it's going to be an electric vehicle. I think that we've committed in a lot of cases, not only because companies have moved in that direction, but the government itself has moved in that direction, and they've decided that electric vehicles, notwithstanding the problem that we're having with creating batteries that don't give us a lot of pollution in getting the things that we need together to make the batteries, but they've decided that electric vehicles are where we're going to go because they're kind of watching just the emissions coming from the tailpipe, and the emissions are acceptable. The emissions that come from the tailpipe of a hydrogen-powered vehicle are water and a little bit of heat. That's all that's going to come out of that tailpipe if you in fact ever even had a tailpipe on that vehicle. And this is a diagram of what Plug Power would like to see happening all over the country. They'd first of all like to have a renewable power source that's up in the upper left-hand corner. And that power source would be used to power electrolyzers. That's the icon that's next, kind of down into the left a little bit, down into the right a little bit, right there. Those are electrolyzers, and that's the clean way, renewable energy being used to tear water molecules apart into oxygen and hydrogen. And hydrogen is the interesting molecule that we can use for fuel. Oxygen, of course, can be released into the atmosphere, or it can be used as an industrial gas. Has a lot of uses for oxygen, but hydrogen is the gas that we're most interested in. We'd like to be able to use these electrolyzers, pull the hydrogen out of the water, and liquefy it into something we can transport in large trucks. Bring it into storage, and then move it from storage to dispensers. And dispensers can dispense this fuel into vehicles in much the same way that we dispense gasoline into vehicles right now that most of us drive on the roads today. Now, I know the first picture that might come to mind is the explosion of the Hindenburg over New Jersey.
You told me I couldn't use that picture.
And I know I did, yeah. And the accompanying explanation was that hydrogen was extremely combustible. I want you to remind yourself
So is
that the fuel
gasoline.
that we use today, well, that's what I'm going to say right now. The fuel we use today, gasoline, is also extremely combustible. And we've found lots of ways to handle the creation, the transportation, the storage, and the dispensing of gasoline. We probably have an infrastructure more set up to convert to hydrogen than we have set up the converting to electrification of our vehicles.
Yeah,
What's also tantalizing about this process is that it takes approximately the same time to refuel a car with hydrogen as it takes to fill the tank with gas. You're not talking about half an hour or an hour and a half to recharge the car. You're talking about filling the tank just as you currently fill an internal combustion engine tank with gas. We've reached the point with internal combustion that we can't squeeze out any more power from the gasoline that we use. And that means that a lot of the power from the combustion still goes into things like heat and light and noise and all different other kinds of things that aren't really moving the car forward. We're quite a ways away from being able to squeeze out maximum usage from the combustion of hydrogen. We have engines today that are fueled with hydrogen gas, liquefied hydrogen gas. We have engines both in vehicles and many more in the kind of engines that you would use in warehouses, for example, that occupy acres and acres of land, forklifts and vehicles that run today on gasoline, and in many of the warehouse structures are now being run on liquefied gas. They're not on the roads, but they're being used to give no emissions at all from the warehouses that they're doing the work in. So this is where Plug Power would like to be. They'd like to see these units all over the country. Let's go to the next slide,
it's a
Mark.
neat area. I just wanted to make a couple quick points. I talked to a friend who works in a very related field, and he says one of the ways you can kind of characterize it in your mind is to think propane and how much we don't even think about propane in much differently. Yeah, you have to be careful with it. All those things are still true, but there's a lot of similarities. Not exactly the same, but a lot of similarities. And the other thing was I was encouraged to take a look, and I did, at this little guy down here, forklifts. There's been a bunch of hydrogen backfits on forklifts in warehousing, and the reason being, most of those were basically switched over to batteries like 20 years ago, maybe 30 years ago, and handling of batteries and the inefficiencies of the process are pretty crazy. What they find is when they basically switch them out for hydrogen fueled forklifts, you basically have these distributed about the warehouse or factory, and a lot of the process is greatly simplified, and the machinery operates better, handles swings in temperature better, and it could also almost be thought of as a microcosm for what could happen with other modes of transportation. And that's kind of the thesis behind all of this. So it's fascinating to see some of the projections as to what is happening. You will find that a whole lot of forklifts have been switched to hydrogen fuel already.
Yeah, when we talk about hydrogen, next slide, Mark, if you
Yeah, go
could.
ahead.
When we talk about hydrogen, we need to understand that there's two kinds of hydrogen on the market. One is called gray hydrogen and one is called green hydrogen. Green hydrogen is what Plug Power is trying to produce, and that means it's being produced using nothing that will pollute, nothing that will add to the carbon load that we have in the atmosphere. And when it finishes, it has virtually no emissions. Now, gray hydrogen has virtually no emissions when it finishes its job either, but gray hydrogen, for the most part, is produced by stripping the hydrogen from gases that are produced as byproducts of drilling oil wells or of fracking or of actually creating the different products from petroleum itself. In other words, gray hydrogen comes from fossil fuels and has the same problem then with carbon load as we do with regular fossil fuel. You can see the speed at which this plant in Camden County, Georgia has been built. The normal time to build a plant is somewhere between 3 and 4 years. And this plant has been under building. It took just about a year to build, and it went online in May of 2023. You can see the pictures of the site and how quickly things came together. And you can see it down working the night shift there with all the pretty lights on it today. But what is interesting about the plant is that it's going to be now producing in bulk one of the few sources of this green hydrogen that exists in the world in any great amount, at least. What's nice is that the model for this building of the plant and then using the plant, this model is an American model, and it sits in Georgia. And the company is interested in duplicating this model all over the country and making hydrogen a fuel of choice and giving drivers the ability to not only drive an EV in 3035, but maybe drive a hydrogen-powered vehicle in 3035 or sooner. I've explained some of the
2035.
2035, yeah. I've explained already some of the benefits of the car, and again, I go to the point of refueling, and refueling seems to be the biggest issue that differentiates the hydrogen-powered car from the EV. That's assuming we find a way to make batteries that don't use materials that we have to mine in a very dirty kind of process. This slide has a lot of words on it. TPD, that's tons per day. And most factories that exist in the world right now are producing very small amounts of this green hydrogen. This Georgia plant is going to be producing hydrogen that can be measured in tons per day. And then the plant will serve as kind of a template for plants that they plan to build in other locations. The next one is planned and work will start very soon on a Texas plant that initially will produce 45 tons per day of green hydrogen. Next slide, Mark. One of the biggest impacts of all of this is going to be the reduction in the cost of hydrogen fuel. Right now, if we were to fuel a car with gray hydrogen, we would find that filling the tank cost us about 3 times what it costs to fill it with gasoline. But if we can cut the price of hydrogen so that this green hydrogen is competitive with fossil fuels, then we can begin to say to people, you know, you can buy yourself a hydrogen powered car and operating it is going to cost you roughly the same as it costs to operate an internal combustion engine. It also would solve a lot of problems for governing units, whether it be cities or counties or states or the entire country, when we begin to deal with the problem of how are we going to pay for roads if we have a complete electric fleet. We're going to have to put surcharges on miles, or we're going to have to set up tolls for most of our roads, or we're going to have to greatly increase the cost of electricity. That's not even bringing up the question of whether our current grid is robust enough to serve as a producer and generator of energy for the number of vehicles that we would have in the country. A plug power is expected to achieve $100 million of margin improvement as it moves from using gray hydrogen to make the liquefied hydrogen to using the green hydrogen. They anticipate the green hydrogen will be produced at 1/3 of what they're paying now for this gray hydrogen. Think about that. Forecast customer demand right now is 65 tons per day. Remember that the plant opens with approximately a 45 ton per day output. And so they'd be expanding this plant as well as building many other plants as their customer base increases. Next slide. Here's where they are right now. They have a plant in New York outside of the city, one in eastern Tennessee, one in Louisiana near the oil fields near New Orleans. And they're looking for a plant right now somewhere in the middle of Texas. I think that's oil company. Somebody in our audience can probably correct me about whether that's oil company or not. But you can see by the circled lines that in the year 2025, they're looking to increase what they're doing into somewhere in the Midwest, a second Texas plant, a second Gulf Coast plant, and somewhere in the Southwest. Now, you'd think that I would be plugging Plug Power as a stock to take a look at. Folks, to be honest, this company is not the kind of company that I would be investing in. I'll tell you that they've gotten bad marks for handling of their money. They have not been able to turn a profit after promising a number of times to be able to turn a profit, but they are among a small handful of companies that's actually been able to begin to produce green hydrogen on a usable basis. You see some of the goals that the company has right now and some of the things that are happening, they hope, by 2030. And then you see how those goals increase as they move to 2050. These are goals that the company has. Nothing says they're going to achieve those goals, but the company does a lot of serious thinking, and they communicate pretty nicely with their website. Next slide, Mark. This I find extremely interesting. It's at the bottom of their investor relations page. It's also at the bottom of their homepage when you go to their website. But when you look at the About Us category and you start to open up any of these menus under About Us, Our Story, for example, you are not only led to things that this company created as far as literature and education, but you're led to all kinds of articles, many of them very positive about hydrogen, and many of them taking the time to point out some of the negatives. if hydrogen fuel is something that interests you, I think this is a great website for you to jump from as you begin to teach yourself more and more about how it works, how they make it, and how it could be used. I'm not plugging Plug Power. In fact, it's not at all the kind of stock that I would even look at more than once as far as an investment's concerned at this point in its life. I do think, however, that if you have a speculative bent for stock picking, that it might be something some of you might choose to speculate in. I have a member of one of my investment clubs that bought Plug Power a long time ago. The company's been in existence since somewhere around the turn of the new century. And he saw the price move up into the hundreds of dollars where he sold. Today it sells for $8 a share, $8 and change a share. You can see that big price spike recently back in 2021. But again, the company made a lot of commitments, a lot of promises, and then was unable to deliver. And this is the kind of price bars you can expect when you see a company being unable to deliver.
All right,
Mark,
so
I'm not sure why Air Products is at the bottom down there, but I assume Air Products is a competitor.
no, we're just looking for something to help us sink our teeth into. You know, you say you wouldn't invest in it. This is the type of company that I might. I will tell you that I was extremely skeptical when I started studying this company. I'm still pretty skeptical, but I'm less than extremely skeptical. There's some interesting stuff here. First of all, I do want to point out to the audience that, you know, Hugh McManus brings us many interesting companies that don't have earnings, but I do not remember the last time that Hugh McManus brought a company that had negative revenues. So Ken, you get a gold star for that. They actually had minus 93, I believe, million in revenues in the year 2020. I don't know how you do that, but they did. So Ken, take a bow. The other interesting thing here is, you know, with all the stuff operating down around zero, all of these scales have been switched away from logarithmic. So they're basically straight up. Non-logarithmic graphs. You can see the volatility in the price, but what is fascinating is right here. Because if these guys figure out how to really scale and deploy what they're doing, and if this demand actually does materialize, you are looking at a very interesting situation. The numbers on Value Line are off the charts. Air Products is here because they operate a similar type business in dealing with these gases. And all I was looking for was some way to gauge whether this projected operating margin of 31% made any sense whatsoever. You can see here for a similar type company, not exactly the same. We're just looking for rough ballpark estimates. You can see that Air Products actually operates in that 30 to 40 range for operating margin, somewhere around 20% for net margin. So maybe this number here is a little bit beefy. And again, we're just looking for some back of the envelope type thing to say, could these numbers be real at all? So that's why it's there, Ken. And
I wanted to keep my presentation to something that was relatively short. Matt Spielman, who's in our audience today, brings up the point that if hydrogen is going to be used throughout the country, we're going to need pipelines for it. Like we have pipelines right now for natural gas and for oil and for other products. Natural gas pipelines cannot be converted directly to carry hydrogen. The hydrogen needs to be under more pressure. The pipelines need to be specialized. And that, of course, is a huge negative for the whole idea of using this nationwide. But we do have ways to move from these centers to distribution points, it does go into tanker trucks fairly easily. And so you could conceivably have pockets of this kind of transportation happening earlier than you could service the entire country. There's a big problem with getting this clean hydrogen to all parts of the country so that it would be available in stations anywhere that you might need the fuel. It's one of the negatives that pits it against the EV, the electronic vehicle. But I think at least it should be discussed and debated, and we should have the opportunity to know that this is a completely viable technology, and it's a technology that can be made so that it's basically 100% green if you choose to put it in that fashion, to make it in that fashion. I was told that the Texas dot for the second Texas plant is in a place where there's probably excess wind capacity right now, which would make it a perfect place for one of these kind of units.
Big wind.
Yeah, make it a perfect place for one of these kind of units, because that's clean energy, and then it would be making the hydrogen, which could be turned into clean energy as well. Yeah, so that's enough on the topic for now, Mark. But yeah, thanks for giving me the chance to stand on my soapbox and talk about it a little bit.
You bet. In fact, that New York location, I believe, is a place where it's very difficult to inject any more electricity from a wind farm into the infrastructure, the electrical infrastructure. This would be immune from that. So you could actually be capturing some of that. It's an ideal place for windmills. They just can't do anything with the electricity. This is an answer to that also. All right, coming attractions. We do have the roundtable next week. Ty Hughes and I will be collaborating on the Thrift Savings Plan presentation on October 3rd. Mark your calendar. And then we'll have those other topics coming up as October unfolds. I'm just wrestling with this notion of a Stonk Oberfest. And I don't know what I'm doing with that yet, but who knows? Something might erupt. Okay. Anything you want to add, Ken?
Well, I'd like you to explain what STONK stands for, Mark.
Well, STONK is a reference to that dumb money situation with GameStop, where the people on Reddit basically refer to stocks as stonks.
Okay.
So they'll say, I like the stonk.
All right, great.
So it's a dumb money celebration. So it could be fun. Who knows? I haven't decided what to do yet. All right. Here's a reminder that we archive these sessions on YouTube, both the roundtables and the bull sessions. Just go to Manifest Investing on YouTube, and you can actually listen to some of our work from the past. 2 quick slides to end the pictures. The one on the left is from Laura Scott. That happens to be the bay in Tampa. And the one on the right is Lake Orion here in Michigan, a few miles from the house. Anything else on the hopper right now, Ken?
Nothing in the hopper at the moment, Mark, except right. that we'd love to see a lot of you at the roundtable that's coming up next Tuesday. And if you don't have a link to the roundtable, drop me an email and I'll make sure you get one.
All right. And there's a whole lot more homework to be done with respect to how hydrogen works in pipes and cars and everything else. But
absolutely.
Thank you, Ken, for at least launching the subject and taking one notch off my skepticism. All right. So with that, everybody, have a good week, and send us your best ideas for the roundtable.
Good afternoon, all.